case, in the case question that I gave it to you, not the case question, in this question number 1, the bond question, the bond problem that I gave it to you is actually the very fundamental problem that you should be able to resolve it even when you're taking MGAB02. Now you're in MGAC02, and then I think if you're still struggling working with something like this, then I highly recommend you go back and really practice and understand those concepts well, because these are the things that are very fundamental. So I'm actually quite concerned about this. The other one is that they're also talking about that, we did talk about modifications of the loans and different things. And then we spent quite a bit of time discussing about whenever there's a modification, you have to understand if the modification is substantial or not. Because if anything, if you take the present value calculation between the old arrangement and the new arrangement, if the difference is more than 10%, then it's a major modification, and the accounting treatment is quite different. Now in this particular case, then many of you did not really recognize, the number one, you did not even recognize that there is a more than 10% difference, and you should be even treating it as something that's substantial. So that's another issue. I'm actually quite concerned. I think we did spend almost the whole class talking about loan modification, right, if you remember. The DBO code calculation is also disappointing. They said that many students did not know how to calculate the interest expense. I spent a lot of time talking to you about how interest expense and interest income should be calculated because they're the same way. And many of you did not even know how to calculate the actuarial loss, which again, a lot of these are very fundamental. So I urge them to please make sure you practice and making sure you actually understand what those concepts are. The other thing they talk about is on the planned assets, the expected return, the experience gain were not attempted by maybe all the students. Now we did talk about that question, that normally speaking, you would only include the expected return into your reconciliation, and then you would have to compare the actual return and the expected return to come up with your experience gain or losses. I mean, these are the things we have gone through, quite a few questions in the pension. These again are very, very fundamental issues that I actually come across that I would expect students to know. And again, if you are not really understanding these issues, I'd be very, very concerned for you to get through MGAC02. That's one thing I just want to leave with you. In question number 2, which is talk about leasing, I think many of you are not calculating the lease payment amount correctly. Lease payment is something we went through many problems actually in our calculations, and if you would have practiced those questions I gave it to you in the class, this should not be a very challenging question you need to work with at all. This is why I'm actually having some problem understanding why the results were so poor this time. Now many students actually struggle with the interest, income, expense, and the journal entry for both the lessor and the lessee. And then many of you even forget about the depreciation expense entry relative to the lessee side of the accounting of the entry. So again, please take a look at them because those are the things you need to know. Now the other crazy thing is for case writing, I think I must have spent a lot of time explaining to you that every time we write a case, you must start with some aspect of situation analysis by addressing the user, the role, the constraints, and so on. Now many of you, maybe you're short of time or whatever that is, did not even do that. Now that part alone is probably worth about 10 marks. And those are easy marks for you to grab, and I think many of you did not even do that. So that means you're losing all those marks. So please remember when you're working on the final exam, when I give you a case, please start addressing the users, the objectives, the role, and also the constraints. That is something you must remember to do. And then many of you actually do not have an appropriate discussion between the insurance and service type of the warranties. Again, the warranty is a very, very simple concept, and the issue that I gave it to you in the case is relatively straightforward as well. I think many of you are struggling with it. And the other thing that surprises me that he mentioned is that the decommissioning cost present value calculation, many of you did that incorrectly. Now, all these things, as I said to you, are all fundamentals, and I think that I went through all of that. In the exam, if we go across and take a look and then compare to the ones we take up in the class, many of them are quite identical. So I'm asking you to please take a moment to rethink about the way you're preparing for this course and the study. As I mentioned to you, at the end of the day, when you finish CO2, you need to make sure that you have adequate knowledge, because when you go eventually for the CPA designation, CO1 and CO2 are the two most fundamental courses that you must retain those knowledge, because then that's basically what you need to write a CFE. As a matter of fact, if you are really well in those things, you can probably ready to write a CFE after you finish the undergrad degree. But those are the things you need to make sure you fully understand and do well. So I'm actually very, very concerned about the results, as I mentioned to you in the virtual call last time. And then I just hope that you can try to do better in the final exam. That's why I give you a lot of leverage to improve and actually enhance. Please do come see me if you still have problems struggling with those things. But what my conclusion is that I don't know, maybe you're under a lot of stress or whatever, but our exam is after the reading week. I think that a lot of you obviously have not actually practiced a lot of the questions or even make an attempt to even try to understand many of the concepts. So this is the part that concerns me the most. Anyway, I want to leave that with you. I can only help you if you come to me with help, because I don't really know what things you're lacking or what things that you don't understand, but I can only help you if you ask me the questions. So I'm going to leave that with you again. So I would like to encourage you to please study up and ask me any questions that you have. In the second term, we're going to go through a few quite relatively tough topics, and I think those topics would even be tougher than the ones that you take up in the first half of the term. So please make sure that you do fully understand those concepts as we go through them, like some of the things we're going to talk about today. Okay, any other questions for the midterm exam? I did post the solutions and the questions in Caucus, and I encourage all of you to please take some time to digest and understand what are the things that you did wrong, based on what you have answered. Everybody's okay? Because you should have your own answers, right? And then you have the solutions, so you know where you did wrong. But you also get the feedback guide, so you know exactly how those marks correspond to your response. Any questions? Any thoughts? Any comments? Okay, if you don't have any comments, then we would continue on. I think last week we did talk about chapter 16, and we did talk about the hybrid instruments. So today I'd be like to talk about stock options and also the share appreciation rights. Now, for companies that are actually issuing the stock options, usually what we are talking about the stock option is the type of stock options that would be granted to executives and people of that nature. Now, there are two types of stock options. One stock option could be if you work for a company for a long period of time, the company would usually grant the employees sometimes the possibility to actually get the option to buy their shares. Most of the big banks, right, I think once you have reached certain seniority, you are actually eligible to get enrolled in the stock option, stock purchase plan. So basically speaking, that you can actually contribute through your payroll, and then buy up some of the shares over a period of time, whatever it might be. Now for this course, we're not talking about those kind of stock options. The stock options that I am actually talking to you is basically it's basically a compensation type of nature. That means that you are awarded those stock options to employees who did a good job. Usually those are related to senior management. So that's one thing. Now, when you talk about stock options, then I guess the key thing that you need to worry about is that when you issue now, everybody understands why people wanted to issue stock options? What are the motivation, what are the incentive? Why do they want to issue stock options? Anybody? Would you like to be issued as stock options? I'm pretty sure all of you would like to do that, especially for progressive companies, right? If you happen to be working at a startup, then it's probably a good idea to get stock options up front. If you can eventually do well, I'm pretty sure you can pocket like a lot of money. Just take a look at Meta and all these companies, right? They're doing so well. But anyway, for stock option, the general accounting rule is the fact that when you actually every time when you grant somebody a stock option, you do not need to make any journal entries, because stock options are usually vested, right? Now, what do I mean by vesting? Yeah, I think in pension we did talk about vesting. So what's vesting mean?
You have to wait.
You have to wait. Okay, so why do you think stock options is attractive, and why do they want you to vest? Yes.
You stay in the company, and then the better you do, the company goes better, and the stock price goes up.
Absolutely. So basically speaking, because if the company does well, then you do well as well under the stock option scheme. So they do want to, is a way to retain good employees. That's one thing. Then that's another way to reward the employees as well. Now, one good thing from a company's perspective, when a company issues a stock option, they don't have to pay out any money, right, technically speaking. Where did the employee get the money from? When the employee exercised the stock option, you would hope that the share has gone up tremendously, and then because then, actually the employees to pay you, actually when they exercise the stock option. But usually the money they pay you is determined at the time when they exercise the stock option based on the market price at that time. So a lot of times, hopefully a few years later, when the investing is over and you can actually exercise the stock option, you would have hoped that the stock price has gone up tremendously. But because you're the senior executive, you can contribute to that outcome as well, right? So that's why it's motivating in that sense. And hypothetically speaking, the employee can get the money from the market actually, right? When you exercise the stock option, and that means that you buy the stock, you can actually sell it immediately, and you get the cash back from that regard. So generally speaking, it's a very attractive scheme for both the company and the employee from that respect. But remember that one key other thing you need to think about is from a company perspective, there's no cash involved. But it's something that's actually a very, very motivating tool, right, for them to use to compensate the employees. That's one thing. Now, from an accounting perspective, you don't need to make any journal entry at the time when they grant you the stock option. But IFRS requires you to do one thing. During the vesting period, every year during the vesting period, at the time when they grant you the stock option, you must first of all determine what is the fair value of the stock option. And then over the vesting period, you need to amortize that fair value over the period of the stock option. And this is the journal entry you need to do. You would debit compensation expense. And then you would be actually coming up with the entry cost contributed surplus, stock options. So tell me, what is the impact of this journal entry to your financial statements? Any impact? What is the financial implication of this entry? How does it affect your equity account?
Lowers the income. So
It lowers the income, that means it lowers the equity, right? But then at the other end, this actually increases the equity, meaning the impact to your equity is what?
zero.
It's zero. So that's one thing I want you to think about, but they do want you to account for that expense. But then the vesting only you only need to record this transaction based on the experience of vesting. Now, technically speaking, I would think that whoever that's in this scheme are not likely going to leave the company. But in the event they do, then you can actually only account for what you think the experience is going to be, right? So if you think that only 60% of students are going to vest, then you only accrue for 60% of the compensation expense of that fair value. So you only accrue for the 60%. But these estimates could change year over year during the vesting period, so you have to keep on adjusting them to make sure that you recorded the proper kind of experience that you're going to get at the very end of this transaction, right? That's one thing you need to do. Now, when the employee exercises the stock option, then this part of this value has to be included as part of your equity, the share value that you need to account for later on. So in order for me to explain this better, maybe it's a good idea to actually work through a problem with you. Can we take a look at question number 4 in the supplementary question under chapter 16? Can everybody go to chapter 16 and we can go to question number 4? Okay, let me see where I call them up. Alright, so let's take a look at it. Now, what they're saying to you is that in early January 2025, ABC decides to set up a stock compensation plan for its key executives. So then basically they're saying that they announced that on Jan 5th, 2025, they issued 200,000 options to the executives. Now, at the time, they said the option price is $16. That means that when the employees decide to exercise the stock option, they would have to pay the company $16 per share. I hope you're all taking a look at your question together, the supplementary question that we have in question number 4 in your caucus. So please go and find that question so you know what I'm talking about here. Then they said the options were valued at 1.5, so this is the fair market value. You're not required to figure out how those fair values should be calculated. Usually it's based on a financial model. And this is what they come up with, 1.5 million. And they said the option would be vested in 3 years and they can be exercised in 2028, right? And then it's estimated that the first year that 75% of the options would actually vest. So remember what I said is on January the 5th, when the stock option is being granted, there's no journal entry. We just have to make a memo entry to disclose there's an issue of the stock option. Then at the end of December 31st, 2025, because we need to amortize the fair value of the stock option over the duration of the vesting period. Now, because it's 3 years, so I would take 1.5 million divided by 3. But because only 75% we anticipate is going to vest, so I'm only recording 75% of the amount that I need to record in the compensation expense. So I'm going to take 1.5 million.
It says 85% of the option. Oh, sorry.
It's the first year.
Yeah, sorry, first year.
So it's 1.5 million. So that means I will be accruing 375,000 into the compensation expense, and I'll be crediting the same amount to the contributor surplus and the stock option. Now, the employee cannot exercise any of these stock options until they vest, right? So that's one key thing. But that you have to do it for the same thing every single year until they vest. So in the second year, what happened? In December 31st, 2026, they said they are estimating now 85% is going to vest. Now, just like your loyalty program, whenever you have the vesting experience, you have to always bring up the year on a year-to-date basis to that new amount. So normally the good thing to do is to take a look at what we think the total vesting would be based on the new experience, and then work backwards to figure out what the journal entry you need to make to make the adjustment. Because now you have 85% vesting, so if I would have taken 1.5 million divided by 3 times 2 years, that's the base. Then I would need to be vesting 85%, meaning that I should have accrued $850,000 into my compensation expense at the end of the second year. But since I already recorded $375,000 for the first year, that means that the journal entry I need to make in this period to make this $850,000 is only $475,000. So then I need to journalize compensation expense for $475 and credit the contributor surplus for that same amount. When you do this journal entry, your overall contributor surplus stock option is going to be $850,000. That's what should be in the book. Do you understand the concept? Are you okay with this? Do you have any questions? Yeah.
Is there ever a situation where you have to go reverse an entry, or is it always like just go forward?
I think you don't need you can reverse it and just put in the correct entry at the end of the day. You can do it that way. But I think this is easier for you.
But this course just focus on going forward, right?
Yeah, going forward, yes. I think it will be better. Then what happened is in December 2027, what they said is that then 25,000 options are forfeited due to the employee turnover. Now remember, the beginning they have 200,000. So total forfeited is total options is 200,000. The 25 people, what did they say? 25,000 get forfeited, right? So that means that you only have 175 that's actually vesting, Because if they give you a percentage, you need to work out your own percentage. So if you take 175 divided by 200,000, meaning the vesting experience for that year should be 87.5%, right? That's what you should be getting, that's what it is here today. So basically speaking, your compensated expense for the whole 3 years should have been 1.5 million times 87.5%. This is the third year, so you should have accrued $1,312,500 into your contributor surplus for the stock option account. But then you have already accrued $850,000 in today. So basically speaking, in this current period, you only have to record $462,500 into a compensation expense and accruing your contributor surplus stock options here. Is everybody okay? So by the end of the third year, you should have $1,312,500 in your contributor surplus account. Do you get that concept? Are you okay? Then they also tell you that on Jan 1st, 2028, because that's the year they can start, they completed the vesting, they can actually start exercising. They said 75,000 exercising. The market value is $35. Does it make sense that they should be they should be exercising? What was the original stock option price? That means that when the employees exercising them, they have to pay the company how much money per share? How much money per share? Anybody?
16.
$16, right? That's what they need to pay them upfront. Now the market value is at 35. Does it make sense for them to actually exercise the stock option? Meaning what? Meaning if they do exercise the stock option and they turn around and sell it in the open market, they can actually pocket the $18 profit, the profit gain, right? That's what they should have done. Now in the future, actually, if you are ever giving a stock option and you invest in it, even though you might have to borrow money sometimes to actually you borrow money to exercise the stock option, it might be worthwhile for you to do it because then your out of pocket will be very limited, right? But then your gain could be quite substantial depending on how the share price goes over those years. So something to think about it, like if the interest rate is not overly steep, then maybe your return on the stock that you can be getting on the open market could be substantially more than what you need to borrow the money, pay for the interest to get those stock options. It's something that you should always consider, right? As an example. So in this case here, what they're saying is that they would be exercising. I'm surprised that only 75,000 options are being exercised because then you would have thought everybody should be exercising it. But anyway, in this case, they only tell you 75,000 options exercising. So I'm going to take 75,000 times $16 because that's how much they need to pay to the company. So from a company perspective, right, they'll be debiting cash for $1.2 million. Then they have to take a portion of the contributor surplus and the stock options to the share value. So now we know that the total contributor surplus in the account is 1,312,500. They only exercise 75,000 out of 175,000 because they did 25,000 forfeited, right? So they only have 175,000 stock options that are still active. So that means 75,000 out of the 175,000 is still active. So that's the amount that they would be actually they need to take a portion of that amount and put it in the share value. So I'll be debiting contributor surplus stock options for that amount, and then I'll be crediting the total common shares with a combination of what the employees pay you and what the contributor surplus and stock option is. Are you okay with that concept? Are you able to understand the concept? Are you able to follow? Stock option is again a very straightforward situation. Then they said at the end of the year, then the remaining stock option basically expired. So what do you have to do? Normally speaking, the stock option, when you set up the account called contributor stock option, this account should only be used for the stock options. But since the stock option is now expired, you can actually take that amount and put it into the open account. You should take it out of the contributor surplus stock option account and just put it in the generic contributor surplus account, right? Or you can put in the debit contributor surplus stock option and put in the contributor's expired stock options. What does that imply? That implies that this amount of money, just like any other equity account, you can actually use it to whatever you need to do, for your company expansion or whatever you need to do. That's the amount that you can, that's the money that you can use. Is it okay? Do you have any questions? Because those are already accrued, right, in the expense. Everybody's okay? Do you have any questions about stock options? Do you understand what we're doing here? Everybody's all right? All right, if you're okay with it, I would like to go on and talk to you about another concept of this chapter. In chapter 16, as I said, I'm really covering 3 different topics. One is the hybrid instruments, which we talked about last week. And then the second one is stock option. And the third topic I want to talk to you about is what we call the share appreciation rights. Now, share appreciation rights is a similar concept to stock options. Now, what we are trying to do is that the company, if they are doing well in the stock market and they do want to share the upside of the share price together with their employees. So normally speaking, they will issue what they call the share appreciation rights when the employee are actually exercising them. And when they're reaching, they also have vesting period, the same concept as stock options. But what happened is that then stock option is an equity instrument, right? But when you do share appreciation rights, from the company's perspective, it's a commitment. So what's the difference? Stock options equity, then share appreciation right is becoming a liability because that's what their commitments are. Are you okay? So when you basically have the same concept, you need to now the interesting thing about from an IFRS perspective, the share appreciation rights can be traded can have a fair value on its own. So you always need to evaluate in your account what is the fair value of the share appreciation rights. And the exam timing, you don't need to figure out what their fair value is. You will be given the fair value. You just have to remember that you always need to record those share appreciation rights, whether they exercise or they don't exercise. You always record it at the most current fair market value. That's what you need to record. That's one thing. Now, share appreciation rights, just like stock option, they need to be vested. So again, you will only need to account for you would debit the compensation expense, that's what you did here, but you would credit SAR liability, right? Share appreciation rights liability, and then you need to vest it again. You need to amortize those costs based on the fair value over the duration of the vesting period. Now remember, every year your fair market value could change, right? So you have to keep on adjusting to make sure that you have up-to-date fair market value before you account for the journal entries. Is that okay? That's one thing you need to do. Then after the vesting period is over, then you can actually, the employees can redeem. Now, but this is the tricky part. Now, from the IFRS perspective, there's always what they call a benchmarking price, because the idea is that then, when the company give you the share appreciation rights, they would come up with what they call a benchmarking price. So let's say if the benchmarking share price is $60 a share, if the market price is $65, then the employees, everyone who has a share appreciation right, can potentially share the gain, which is between $65 and $60, right? Because they would always be benchmarking the most current market price to the current market price to figure out the spread between the two is what the employee would get if they exercise those share appreciation rights. That's one thing you needed to account for. Is that okay? So that's one thing you needed to do, okay? It's actually quite tricky when it comes to share appreciation right because of all these different transactions you need to do, and sometimes that would be quite complicated when you try to record. I'm going to go through a fairly complex question with you so understand what those things are. Now, IFRS and SB, the rules are actually quite different. So I'm going to talk about IFRS today, and then next week I will talk to you about SB, right? Is it okay? So this way you won't be totally mixed up. All right, if we can take a look at question number 5, and then take a look at what the implication is. Now again, just like the stock option, you would only be accounting for when you're doing the vesting period, you only be accounting based on the experience of vesting. Again, you only need to record the compensation expense relative to the vesting experience. So in this case, they give you on Jan 1st, 2025, they again establish a cash settled stock appreciation rights plan, which is for the employees. Now, again, most of the time, these kind of plans are usually for senior management or the executive, so those are the things, but the same concept applies. They do want the employee to enjoy the upside of the share price, right? That's really what those plans are for, similarly to the stock options. So the intention is to hold the employees to the company. Anyway, they said to you that they issued 50 SAR to each of the 250 employees. Okay, so that's one thing you need to keep in mind. Then the other thing is they said to you that each SAR is entitled the employee to receive cash equal to the difference between the market price and the benchmarking price. In this case, they did tell you $60. That's what the benchmarking price is. The SAR vested after 3 years of service and they expired on December 31st, 2029. And then so they give you for each of those years, they tell you how many employees leave, and they're estimating how many more employees would leave. So that give you what the vesting experience is. So you need to bring that out. Remember, by 2029, actually they are able to start exercising them, right? By 2029, right? That's what they needed to do. By 2027, actually, right? When are they ready to exercise? They expire on December 31st, 2029. And then they can actually, they only have the vesting for 3 years. That means that they can actually vest them, because they issue in 2025, they can start vesting them in 2028, right, at the end of 2028. So keep that in mind. Anyway, well, let's go through each of the transaction. So during 2025, they said there's 20 employees. That's the year they actually issued the share appreciation rights. But during 2025, they said 20 employees leave, and they estimated 45 more is gonna go. Now, when you work on a SAR scenario, I would like you to create a table of this nature. We have the date of the transaction, which you usually record them in the year. You need to figure out what the SAR fair value is. You need to figure out how many is the SAR and what is the total SAR value. And then you need to figure out how much they have accrued, what is the closing balance of the SAR liability account, what's the opening balance, so you can figure out how much you need to expense for that year. Now, 2025 being the first year, and then the number of employees that they currently have, right, is basically, they said in the beginning they have 250 employees, but then they said in the first year, 20 employees have left, okay? And then they said that 45 is estimated more to go. So they only have 185 employees left that they estimated would be leaving at the end of 2025. Every employee is gonna get 50 SAR. So that means that at the end of 2025, they should have 9250 SAR. First of all, do you understand what I'm doing here? I'm trying to figure out what is the vesting experience. How many employees will be actually there at the end of the period? And they said that this is based on what they tell you. They said 20 people left already and 45 is expected to leave. So that means at the end of the year, they should only have 185 people, and then each one is entitled to 50 share appreciation rights. So that means the company will have issued 9250 share appreciation rights. Now, where do I get the share SAR fair value? They gave you the table, and they said that on December 31st, 2025, is running at $7.20 as a fair value. As I mentioned to you, you always have to use the fair value to assess the SAR value, right? So I'm gonna take the 720 times 9250, so my total SAR value is 66,600. Are you okay? Do you have any questions so far? Do you follow what I'm trying to do? But you're vesting over 3 years, so I'm gonna take 1/3 of that amount, and then this is what I would be accruing at the end of the year. So my journal entry would have to be debiting compensation expense and crediting SAR liability for 22,200, and this is what I should be in my SAR liability balance account. Do you have any questions? Do you understand what we are doing for the first year? Because it's relatively straightforward, I hope. Anybody have any questions? Okay, if there are any questions, let's go to the next year. Now, for next year, what they're saying is that then, during 2026, they said 25 employees leave, and the estimate to be 35. But remember, the first year, 20 people was already left. The second year, another 25 left. So on a year-to-date basis, they actually have 45 people that have left, right? And then how much more did they estimate to leave? They said there would be another 35 that would be estimated to leave. So that means they should only have 170 left at the end of 2026. And then every employee should be getting 50. So that means they should have 8,500 as the SAR they have left at the end of 2026. Now remember, the fair market value has changed in 2026. It's now 775 per each SAR. So I put 775 multiplied by 85,000. So this is now my total new SAR value, right? I need to accrue 2/3 of this amount. These are 2 years of vesting. So that means in my accrual, I should have 43,917 as my closing balance for the SAR liability. I accrued 22,200 in the beginning, in the first year. So that means in the current year, I should only be expensing 21,717, which is the difference of the two, right? Do you understand? Is that everybody okay? So my journal entry will be debiting compensation expense for 21,717 and crediting SAR liability for 21,717. But then if I add the first 2 years, this is the total amount that should be in my SAR liability account, which is 43,917. Are you okay with this? Do you have any questions? Do you understand what's going on? Do you follow? Because we're going to do something a little more complex in the third year. Everybody's okay? Alright, if you're okay, let's go to the third year. The third year, what they said to you is that they said this is the last year of the vesting. They said there's another 20 employees leave, and there's also 70 employees exercise the SAR. Okay, so 70 employees exercise, you have another 28 people that left. So in total, how many people have actually left? The first year of 20, the second year of 25, the last year of 28 that physically left. So my total number of people that actually has left is 20 plus 25 plus 28. So the number of people that actually left is 73, right? So that means I should only have 177 left in the pool, and every one of them get 500 SAR. So I should be getting 88, I'm sorry, I should be getting, it's 50, right? I should be getting 8850 SAR in the pool. Now remember, the SAR value has now gone to 910. So that means based on this, I should be accruing 8535, and I should be accruing the full amount. Last period, year to date, I should have 43,917. So that means that I should make a journal entry to debit the compensation expense by 36,618, and then crediting SAR liability by 36,618. Is that okay? Now, but then they're redeeming 70 stock options, 70 SAR rights have been redeemed. So what do I need to do? So that the employee redeemed is 70, and each one is entitled to 50 SAR. So you have 35 SAR that you have redeemed. Now, what's the price you're redeeming at? Is the difference between the fair market, is the difference between the current share price, right, relative to the benchmarking price. So for the third year, what is my share market price, anybody? In 2027, what is my share market value price? Okay, take a look at the table and let me know.
65.5.
65.5, meaning what's the spread?
5.5.
5.5, and that's what they're receiving, right? That's what they should be receiving. So that means that you should be taking out 19,250 from the pool, okay? Because you need to, you're withdrawing 3,500 SAR rights, you should be withdrawing 19,250, and this is the value you should have left in the pool. But remember what I said to you earlier, you should always report the SAR based on the fair value. And what's the fair value? Now, you only have 5,350, right? The fair value is 910. So that means that technically speaking, in the account, you should be only recording 48,685. But because of the draw based on the benchmarking price and the current market price, your value that you're showing is 61,285. So that means that in order for me to bring it back to the fair value, I would have to adjust $12,600 out of your SAR rights. That's what they did, just so you can come back to this level. Do you understand what I'm doing here? Yes.
So that type of calculation, the last one, only happens after redemption, right?
After the first year redemption, that's the most complicated year. The reason for that is because then you would have to, because that's the last year of vesting,
Yeah.
and at the end of that year, somebody actually redeemed. So you have to first of all record it, the fair market value change based on that year, because you have the whole year that you accrued for the compensation expense, that's one. Then the second thing you have to do is, but then when your redemption, the price is not calculated based on the fair value of the SAR, right? It's calculated based on the difference between the benchmarking price and the current market price. So once you take it out of the pool, then your value may not correspond to your fair market value. Then you have to make the adjustment to bring it back to the fair market value. Do you understand the concept?
So only when it's redeemed do we then care about the current value?
Yeah, you need to understand what's the value you're paying out as a redemption. That's what we did here.
Because like if you don't redeem it, then it doesn't really matter.
That doesn't really, if you don't redeem, there's no issue. But then because of the redemption, it actually messes up your fair value calculation, right? So that's why you now need to bring it back to the fair market value by reducing the SAR right balance by 12,600. So in this case, you have to make 3 journal entries, right? The first journal entry is to record the last year of vesting. The second journal entry is to record the redemption. And the third is to bring, after the redemption, is to bring the final SAR value back to the fair market value. So basically what you needed to do is, number one, you debit compensation expense, crediting SAR liability by 36,618. Then you need to debit the SAR liability and crediting cash because you're paying down the liability and this is the cash you pay out. And then you need to make sure that everything is brought back to the fair market value. In this case, you want to reduce the SAR liability to make it balance. So you have to debit the SAR liability and you're crediting the compensation expense. So at the end of the day, you still go back to this fair market value, right? It's what you should have in the book. Do you understand these 3 different transactions we need to record? Do you have any questions? This is the most complicated aspect of the whole thing. The year after is going to be easier. You okay to follow the concept? Okay, the next year, what happened? It's only redemption now, right, going forward? So in 2028, all right, then you have 55 more people exercise, right? So you need to redeem 55 people. And then they are redeeming 50 units, so they will be redeeming 2,750 of those. Let me see here. Yeah. So basically speaking, then, but what's the redemption price that they need to give out? How much money that they need to, how much money did the company need to pay out? Anybody? What's the current market value for the shares? 68 versus what? 60, right? 60 is the benchmarking price. So you pay out $8 per share. So this is the amount that you paid out. So if you take a look at the balance you brought forward from the last period, if you pay that out, that means this is what the account you have left in the, this is the number of SAR left, and this is the amount you have left, but you have to bring this back to the fair value. The fair value of SAR is 1070, so that means you have to make an adjustment of 1135, you're gonna bring it up in this case. So you have 2 entries, one is for the redemption, one is to adjust it back to the fair value. So in this case, I would be debiting SAR liability for 22,000 is what the payout is and crediting cash. And then I would need to bring up the SAR value to come back to the fair market value. So that means I need to debit compensation expense for 1135 and crediting the SAR liability for 1135. At the end of the day, your SAR liability should be sitting at this fair market value, right? At 27,820. Is that okay? Can you guys do the last year for me? Can you take a few minutes and do the last year for me? Take a few minutes to just don't look at the solution, right? Take a look at them and try to see if you know how to do it yourself. Okay, everybody has a chance to work on this? Can you tell me what is the balance of the SAR at the end of 2029? Anybody? At the end of 2029, what is the balance of the SAR? Anybody has a chance to work on them? Well, let's do it together. I'm not sure if anybody actually make an attempt, but I do hope that you do make an attempt, because that's the only way you can find out whether you know the concept or not, and then you can ask questions. In this case, they tell you that they have 52 employees left, right? So you take 52 times 50, so you have 2,600, and then the share price is at 66.50. And then they will be subtracting the $60 to give you $6.50 as a spread, so that means that you're paying out $16,900. You only have 2,600 left from the previous SAR, and this particular period you have to withdraw everything, because this everybody redeemed at the end of this year. So basically speaking, you would take the opening value, which is coming from here, which is coming from here, 27,820, and you minus the 16,900, so your balance is 10,920. But remember, you don't really have a balance, right? Because all the SL is already redeemed, so that means you got to write off the remaining amount that's sitting in the balance. So that means, again, you have two journal entries, one to record the redemption, one to record the write-off, to bring everything back to zero. So that's why you need a debit SAR liability for the cash payout, and then you need a debit SAR liability and credit compensation expense to reverse everything out. Okay, so at the end of the day, your SAR balance should be zero, right? Accrued liability, because everybody's redeemed. Are you okay? Do you have any questions? Now as I said, the SB rules are actually a little bit different, which we'll touch on next week. Similar, but not the same. Do you understand the calculation? Do you have any questions? So this is the last topic I want to cover for this chapter. Any other questions? The other thing is that I believe your case assignment 2 is actually due in a couple of weeks, so I ask that if you can start looking into it and see if you have any problem. Next Tuesday, I don't mind maybe having a quick chat with you about the case assignment 2, just to make sure that you're working out okay with that assignment. Is it all right? Okay. We do have a edit class tomorrow I think at what time? At 1 o'clock, I guess, right? Between 1 to 2:30 tomorrow. I should be able to make it to that makeup class in the event that if you waited for me for like 10 minutes or something, because I have an appointment I need to go to tomorrow morning. So, but I should be back by that time, but in the worst case scenario that I'm not, if you waited for me for like 15 minutes, I didn't show up, then please leave then. I'll reschedule that makeup class, is that okay? But chances are that I should be able to attend the session. Okay, everybody's okay? If not, then I most likely would do it on Thursday instead of Wednesday. Okay, if you're okay with this, I would like to start talking to you about the chapter 18, which is to do with the deferred income tax. And in the makeup class tomorrow, that I will be actually covering the leasing under the SB scenario. I'll go through a couple examples with you, and then continue on with chapter 18, and hopefully we can finish chapter 18. I just wanted to mention to you that there is only maybe 3 more classes, and that will be the final exam. I think I posted the information for your final exam already. I think they are on, I think it's on August the 12th, right? I think that's what, between 9 to 12, and it's gonna be held in the IA building. So please take a look at my announcement. I give you some flavors about the exam. Now, normally speaking, for the final exam, you're gonna have, in this one, I think you probably have around 14 or 15 multiple choice questions, and then you're gonna have 3 problem and 1 case. Then you need to do within that 3-hour time frame, right? So please make sure that you are okay with this. Usually speaking, for my final exam, the problem question is only coming after the midterm, but then the multiple choice and the case will be comprehensive, right, for the whole term. So please keep that in mind. All right, so first of all, we need to talk about deferred income tax. So what is deferred income tax? How many of you are taking C50 or how many actually, I should ask, how many of you are taking D65 or have taken D65? Nobody's taking D65? Nobody here in this class? How many of you have taken C50? Only one person, a few people? Okay, so this chapter definitely is more related to D65 than C50, but I think it would be nice if you would have taken D65 and understand some of the things that we talked about here. But anyway, so what is deferred income tax? Anybody? Why do we need to defer income tax? Deferred income tax could be in the form of an asset or liability, right? But then why do we need to defer income tax? Now remember that when you are working on the financial results, first of all, you will be based on GAAP, right? That's how you come up with the financial results. That's one key thing. But then when you're working on the tax basis, what is the basis when you work on the taxes? Are they based on GAAP? They're based on the Income Tax Act, right? Are they usually the same? They're very I'll give you some example. There are very obvious differences. When you look at the accounting basis, they're more on accrual basis. But when you look at tax basis, they're usually on a cash basis, right? Are you okay? So there's fundamental differences. There are many different things that on tax purposes, you can deduct, or vice versa, then in accounting purposes, you cannot deduct, or vice versa as well, right? So you take a look at those differences. Now, what is deferred income tax? Deferred income tax is because of the fact that when you're working on the income tax, you need to convert the accounting income into taxable income. And because you're converting it using the different rules, many times you will be paying more taxes once you convert, right? Or you'll be paying less taxes when you convert, okay? When you're paying more taxes, then what happens is that you created what we call like an asset, because you're creating like a prepaid, as an example. That's what the concept is. From accounting perspective, you actually be paying it, because you're paying more tax from an income tax perspective, but accounting said that you're not really required to do those things. But tax purposes, you need to pay them more. Then in that case, you create yourself an asset. That's what we call a deferred income tax asset, because of the fact that you end up paying more taxes after the conversion. Okay, that's like you have created a prepaid for accounting purposes, right? That's what the concept is. Please make sure you understand those concepts, because deferred income tax is an area where students get so confused. Okay? Now, many times that because of the conversion, when you're converting from accounting to tax, you ended up paying less taxes because you're deferring those things in the future. And if that's the case, you create yourself a deferred tax liability. Now, for IFRS perspective, they do allow you to net out the deferred tax asset and deferred tax liability in every period. So you can only report the net deferred income tax asset liability at the end of the day. Is that okay? Do you understand the concept in general? Do you have any questions? Okay, now, normally speaking, when you work on a deferred income tax type of problem. This is very commonly, this is a common practice, is what a lot of companies do as well. The first thing you need to do is to actually reconcile your income statement from the accounting basis to the tax base. And normally speaking, we would have to incorporate two type of differences, right, from accounting and tax perspective. The one thing is that then you would be accounting for what we call the permanent difference. Permanent difference, that means that from accounting and tax perspective, they will always be different. Such as what? The one thing you can think about it is maybe, let's say, entertainment expenses. For accounting purposes, if they are legitimate entertainment expense, we deduct 100% of those expenses in your income statement, right? That's what you normally do. But for tax purposes, you can only account for how much percentage? Sorry, somebody? Half of them, 50%, right? Those are permanent differences, because they will always be different. Now, normally speaking, is not the permanent difference that will give you deferred tax differences. But for reconciliation, you do have to account for both the permanent difference and the temporary difference, and the timing differences. It's usually the timing difference that's gonna give you a deferred income tax, because what timing difference means is that then between accounting base and the tax base, at some point in time, you're gonna catch up with each other. You're gonna catch up with each other. As an example, for accounting purposes, we always use strict line depreciation. For tax purposes, what do we use for the CCA? Declining balance method, right? So, but over time, right, are you gonna catch up? You're gonna catch up with each other, right, over time? So that's what we're saying, is that those are what we call timing differences. It's just a matter of timing differences. Because in many cases, accounting basis, you need to use the accrual basis, but for for tax purposes, you're gonna use cash basis. Like warranty as an example. For tax purposes, you only account warranty when you pay them out. But for accounting purposes, how do we account warranty? You will expense them when you need to make an accrual, right? So if that's the case, then for accounting purposes, you actually created a liability warranty. But for tax purposes, will I have any liability? Because tax basis is based on the cash basis, right? That means it's all based on the actual payout. So if that's the case, there's no liability under the tax basis. Do you understand the difference? Do you understand the concept? So after we reconcile the accounting income into taxable income, and we apply for the tax rate, right, what are we getting? We get what we call the income tax payable. This is actually the income tax that should be showing. This is the payable that should be reflecting what your tax return should look like. Because that's in essence your income tax payable account. And normally speaking, we would debit the income tax expense, which in this case is current, because you have to pay them immediately. And then you need to credit income tax payable. So I just want to repeat it one more time. When you're working on any kind of deferred income tax calculation, the first thing we always ask you to do is to do a reconciliation between accounting income and taxable income. Now, when you go through the reconciliation, you have to identify anything that's permanently different, or their timing, or their temporary difference. We call it the permanent difference or the timing difference. Permanent difference are things that are permanently different between accounting and tax. I'll give you some example of those. There are quite a few examples now. This is a dilemma. There are certain things I expect you to know, because those are very common things like entertainment expenses, like dividend for Canadian corporation, right? For tax purposes, you cannot include them as part of the income, but for accounting purposes, you do, right? As an example. There are certain things I expect you to know, but in the exam, if there are some like unusual or something that you probably won't know because these are not as common, then I would usually tell you that these amounts are not taxable, that you know these are actually permanent differences, right? So please make a note. But anyway, you need to account for the permanent differences, and then you need to account for the temporary differences to come up with your taxable income. And you multiply by the tax rate, and that should give you what we call the income tax payable. That's the amount you need to accrue and pay out to the CRA, and then you need to you will be debiting income tax expense current. The reason we call it current, because that's something that's due, that's an expense you incur now, right? And usually you have to pay it out fairly relatively quickly for income tax. Do you understand the concept? Are you okay? Is everybody okay? Any questions? Now normally with deferred income tax, which addresses your timing differences, usually we have to create a schedule, what we call a deferred income tax schedule, right? Are you okay? Now, so I think that I would actually there's a lot of tricks I need to talk to you. If you do the schedule correctly, the schedule will actually tell you right away whether it's a deferred tax asset or liability. Because sometimes you need to make sure that you are actually, that's the case, but the concept is deferred tax asset, meaning that because of the conversion, you ended up paying paying up more taxes, and if that's the case, you create yourself an asset. If you're paying less taxes, you create yourself a liability, right? So that's the concept. I want you to take a look at it. When we go through the example, I'm gonna illustrate to you what I mean by that, right? So this way you can have a better understanding of this. So that's the one thing. I won't go through a DIT schedule with you, just talking about it. I just wanna go through an example with you so you know how DIT schedule actually work. But that's one thing I want you to know. But there are two other concepts I want you to think about it as well. But do you understand the basics? First of all, do you understand what I'm talking about so far? The next thing I want to talk about is the tax rates are usually, the tax rate you need to use are usually based on the tax rate that are actually enacted in the year when they actually apply. So generally speaking, the tax rate has to be enacted. What do you mean by enacted? Who has to approve these tax rates? Sorry? CRA or CRA, but yeah, generally speaking, CRA is just an organization that imposes a tax, right? Who decides what tax rate to use? Yeah, that's the one that carry out, right? The government, right? The government have to approve the CRA rates, right? Are you okay? So basically speaking, that when we say enacted, that means they put it in the legislation. That means this is the tax rate you need to use for this year. Normally speaking, most of the common things is the tax rate is usually enacted in the year when it happened. So when you go to 2027 as an example, they won't enact the rate until probably sometime in early 2027 or late 2026 or something. You will be knowing it just in the year when it happened. But that's the tax rate you need to use for the income tax calculation. The only tricky thing is that then if in the event the government enacted like a few years tax rates in advance, then when you calculate the deferred income tax, you would have to use those rates, because the deferred income tax meaning the impact of that tax is going to be in the future, right? So that means that you always have to use the future tax rates to account for the deferral, the implication of deferred income tax. And when the future income tax rates are known, then you have to use those income tax rates. I'll explain to you how that works a little bit later, but you gotta make sure you keep that in mind. But if you don't have it, you can only use the current year tax rate to figure out what the deferred income tax implications are. You have to use the current year's tax rate just to use it, and just keep on changing it every year, right? But then if you do know the future income tax rate, then that's what you're supposed to be using for deferred income tax calculation. The idea about deferred income tax, the tax is deferring into the future, so that's why you have to use these future income tax rates, right? Only if you know them in advance. That's one thing. Now, what is the rule about loss carried back and loss carried forward? The company has the right to carry back 3 years for the loss. In other words, that if you are profitable all the way through, let's take an example. If the company is profitable from so let's say 2024, 2025, and 2026, and they lost, let's say, I'll do one more year. So let's say in 2027, they have a taxable loss of $1 million. And they've been profitable over these years. They make 500,000, they make 400,000, right? And they make, let's say, $300,000. So this is what the taxable profit, the taxable income is, and this is the year where they have a loss. Now the government allows you to carry back 3 years. In other words, what happened? You can actually offset this loss against the profit you have been recording in the past 3 years. Now when you're trying to apply the loss, right? You can carry back 3 years. Which is the first year you want to apply the loss to? What's the sequence you want to apply the loss to?
The biggest one?
Sorry?
The biggest,
Not the biggest. No. Yes.
The oldest,
The oldest, why?
so it won't be able to go back in the future.
Because in the future, when you go to 2028, you have another loss, right? Then this dropped off, right? So that means you want to apply to the oldest so you can use up these income. More benefit to you, right? In that regard. So just that you always want to apply the oldest. Like in this case, you probably apply 900,000 and you put the 100,000 for 2026, so you still have $200,000 profit in 2026, you have not yet applied, right? So you go to 2027, 2028, if you have another loss, then you can actually utilize the remaining of this because that's within the 3-year time frame. Is that okay? That's one thing you need to do, but remember, you can only, now when I say go back and redeem those losses, meaning you can recover those taxes you have paid in those years. Now, however, the one thing you need to remember is that you can only recover what you paid. So if the income tax rate changes over the years, it's irrelevant to you. Whatever the tax rate that you paid earlier on, that's what your recovery is, because it has to be recovered based on the amount you paid, not based on the current tax rates, remember, right? You're not gonna be better off because of the fact that you're losing money and you're not gonna get anything more than what you paid out to the government. So just remember that when you do the loss carry forward, the loss carry back, you can only recover whatever you pay. Even though the tax rates could be different, you still have to go back to the rates that you actually paid in the year when you pay out the tax. Are you okay? Do you understand the concept? Now, what's less loss carry forward? Now, the government actually allows you to also do loss carry forward, but there's one condition. The condition is that the company has to be proven that they will be profitable into the future. How do they prove it? Definitely, you have budgeting and you have planning and so on, so that will be a way to prove it. So what they can do is they can steal money into the future, right? Every time when you created what we call a loss carry forward, you created yourself a deferred tax asset. Because technically speaking, you are borrowing from the future, right? So that's creating like a prepaid asset you can use in the future. So that means that you can actually bank some of the profits you're making now, right? To be offsetting something that, you can actually bank something that you think you can profit in the future against your loss now. That's what's gonna happen. So you create yourself a deferred tax asset when you are actually doing the loss carry forward, right? That's one thing. But you have to be making sure that when you do the loss carry forward, that you think you are actually going to be profitable in the future. You have to be more likely than not, you'll be profitable. That's one thing you have to prove it. So those are the things I would like you to keep in mind when you're working through this chapter. There are some other tax implications, which I will talk to you a little bit later on this. Now, this is not a tax course, so my focus is more from the accounting perspective, and I don't want to touch on the tax rules, which gets you so confused, because you can go into, because when you go to the CCA pool, potentially you could have recapture or terminal loss and things of that nature, which I don't want to cover in this course to get you confused. But those are the things that eventually, when you go for your D65 and when you are actually working through your CFE type, your CPA exam type of things, that they understanding that you need to integrate everything you learn, right? So in those cases, you might have to apply those kind of concepts against your deferred income tax calculations as well. Is it okay? Is that okay? So right now, I'm just focusing on the accounting side of things, so just make it simple. I wanted to actually take up question number 1 with you. At least do one question or part of the first question in chapter 18. Okay. So the first question that we take a look at is that then, they give you the tax base, UCC, and accounting base, which is basically like your carrying value. So they give you what the tax base carrying value is for equipment. They give you what the carrying value for accounting base is. Now, why do we do this? Because when you do the deferred income tax calculation, you can take what we call the balance sheet approach or the income statement approach. I always like to use the balance sheet approach because it's a little bit easier to understand. So what that means is that when you're trying to figure out what the implication of your timing differences, I use the balance sheet, I use the balances of the accounts that related to these timing differences, right? As a way to come up with that timing difference calculation. Are you okay? So if you take a look at the depreciation example, because depreciation is usually when you take depreciation versus CCA, if I use the balance sheet approach, I will be taking a look at the UCC, which is the carrying value for the tax basis for the assets, versus the accounting carry value to understand what the timing difference creates between the two, right, on the book value of the two. Are you okay to follow the concept to figure out what the timing difference is? Okay, so normally speaking, that's what we call the balance sheet approach. So first of all, they did give you the UCC and also the carrying value from a book perspective at the end of 2023. Then they said to you that the capital development cost, what's capitalized development cost? That's something you should have learned from the CO1. So what's capitalized development cost? Can development cost be capitalized? Did you all pass CO1? Maybe that's a question I should put in my exam too. Can development cost be capitalized? Okay, so first of all, that is my question. Can development costs be capitalized? The question already gave you the answer. Can it be capitalized? Yes or no? There's typically speaking research and development costs, right? So can development costs be capitalized? Yes or no?
Yeah.
Did you not learn this in your CO1? I think you did, right? The development cost meaning you are doing research and you come up with a development, right? You're developing a technology or something of that nature or anything you develop. Development cost can be capitalized provided you meet the 6 criteria, right? There are 6 different criteria you need to meet. Remember? Does that rings a bell? Please go back to your handbook and take a look at development costs and so on. Now research expenses all have to be expensed. Development costs can only be capitalized if you meet those criteria. Those criteria can include things like you have enough money to make sure you can finish the development, you have like a determinable market that you can actually sell these products, you do have a good channels and those kind of things, whatever. So take a look at them. Now, so from accounting perspective, they have an account called capitalized development costs, right? Meaning the development costs are capitalizing, meaning these are the assets they have recorded in the book, right? Does it make sense? So normally speaking, what's in this asset? You have the cost you spend in development that goes into this capital account, and then that will be offsetting by the amortization of these costs, right, as we go. Does that make sense? Everybody's okay? Okay, now why is the tax base 0? Why is the tax base 0? Go to the question and take a look. Is the tax base, they tell you that they don't, like UCC, they don't have anything left in the tax. Why is that 0? Because from the tax purposes, what is the basis? They use cash basis, right? So that means what? Any money you spend, they expense them. Because they use a cash basis account. Everything they spend, you expense them. So there's no asset left behind, right? So that's why they have no asset sitting in the, from a tax perspective, that's why they're 0. Do you understand the concept? Do you understand what we're trying to do here? But for accounting purposes, they do because we treat it as an asset. So you're only amortizing them as you go, right? But for tax purposes, you expense everything as you go. So that means there's no asset left, right? Does it make sense? Please understand those concepts because else you will have time going through this chapter. All right, so let's go through this together. They give you 3 years worth of information. And they did tell you that, take a look at the first paragraph. They said at the end of 2023, that a balance of deferred income tax liability of 105,000. I would like to do the calculation with you, so let's understand what they come up with this number. Then they said that 35,000 is related to the equipment and 70,000 related to capitalized development costs. Again, we will confirm that. And then they would say the enacted income tax rate is 35% at the end of 2023. Now they give you some information between 2024, 2025, and 2026. They give you the net income number, they give you the new equipment acquired, they give you depreciation expense at CCA, they give you the amortization of development costs and development costs related to and incurred in the for tax purpose, meaning when they say development costs incurred deductible for tax purposes, what are they saying? Why are they deductible for tax purposes? They said development costs incurred, these are deductible for tax purposes, is that true? I just explained that earlier.
It's an expense under tax, but under accounting, it's a.
Capitalized, right?
Yeah.
Okay, so that's one thing you need to do, and they gave you the tax rates for each of the years. So what I would like to do now is to come up with a reconciliation between accounting income and the taxable income. And remember, we have to identify, when you do the reconciliation, you have to identify anything that's permanent difference or temporary difference. But if you look at the items they give it to you, there's no permanent difference, because the only item they give it to you is to do with the development costs and the and the asset, right? They have like the CCA and the depreciation expense. So basically, those are all temporary differences, so that means that we do not need to account for the permanent difference in this case. Now, this is the way I would like you to structure your reconciliation, so please follow these formats as you're working through it. Now, the accounting income, to start with, the net income is what we call the accounting income. They've given you as 200,000, 160, and 100,000, right? That's what they give you. But normally speaking, when you're converting it from accounting to taxable income, right, what do you need to do? You need to add back the depreciation expense because it's something you deducted for accounting purposes. Now you want to add it back because you're converting to a tax base. Does it make sense? Why do we need to add back the depreciation expense? Because what are you doing? Why do I need to add back the depreciation expense? For tax purposes, do you deduct depreciation expense?
That makes sense, so.
You don't deduct depreciation expense, right? So you need to add it back so you can come up with the income before any deduction of depreciation, right? For tax purposes, what are you deducting? What is the expense that you're deducting relative to depreciation? The CCA, right? The capital cost allowances, right? That's what you need to deduct. Have you learned about these terminologies in class? I assume in C50, you could have been coming across the CCA and so on, right? Am I correct? Have you talked about depreciation in the personal income tax? You remember anything in the tax course? You hate it so much that you just want to throw away the textbook right away and don't forget a thing? Is that what it is? How long ago did you guys take C50? Don't even remember. It's such a bad course, yes? You haven't taken it, I see. Okay, so who has taken it? So did they teach you CCA and C50?
They taught us about the asset classes, asset class A is 3%, this is 30%.
But did they tell you how to calculate CCA? They must have.
I think they just told us to take the number and multiply it by the percentage and we're done.
That's it?
Uh,
I will validate, I'll get back to you. Okay, so I guess my point to you is that then for the reconciliation, you need to add back the depreciation expense because you don't deduct depreciation for tax purposes, but you do deduct CCA for tax purposes, right? Because the idea is to convert from accounting into tax. Do you understand what we're doing here? Okay, so let's do that first. So first of all, we need to add back 65,000, 70,000, and 75,000. And then we need to subtract the CCA, which is at 80,000, 74,000, and 69,000. That's what we need to deduct. Is that okay? Now also, for accounting purposes, we do, for the capitalized development costs, we do deduct the amortization expense. But for tax purposes, we don't, because we only expense whatever we incurred, right? So you have to add back the amortization expense, which in this case is 40,000, 50,000, and 45,000. And then you need to subtract the capitalized development, the cost you actually incurred, which is 50,000. Are you okay so far? Do you have any questions? All right, so, and then I applied the tax rate to it, right? So because this is the first year, so that means my taxable income is this plus minus all these other things, and then you come up with, these are my taxable income, I applied the tax rate to it, and this is my income tax payable that I need to account for, and I debit to income tax expense, which is the current, and I'll credit to income tax payable. Is that okay? So this is debit. And this is a credit. Okay, I recorded the entry down here. Do you follow? Do you have any questions? It's fairly straightforward. Now, when I give you, you would definitely get a question on deferred income tax in your exam. But when I give you a question like this, please make sure that you don't make any mistakes in reconciling between accounting income and taxable income. This is the easy part of the whole question. This question, the only thing I haven't learned is this question does not have any permanent difference, which we'll pick up from another question, right, later on. Are you okay so far? Then I wanted to talk to you about the deferred income tax schedule, how you need to come up with it. Now, because we are using a tax base and accounting base, now please set up your schedule like this. The reason you wanna set up this way, because then this schedule is gonna tell you you're gonna have a deferred tax asset or liability. That's the beauty about this schedule. So you always start with the tax base, and you always come up with the accounting base, and you know what the difference is, and you would take a look at the tax rate. You take a look at the difference multiplied by the tax rate, that's your year-to-date deferred income tax. Now, for accounting purposes, when you make the journal entry, you don't have to identify them as asset, as an asset or liability. You just charge it to an account called DIT. That's probably one thing, because they can mix up the two, right? So then, so normally speaking, this is your year-to-date DIT. You normally have to take a look at what last year has to give you what the adjustments has to be. Now, presumably, this is the first year, so that would be a little bit easier for us to do. Now, the question did tell you that the opening UCC is 400,000, and then the accounting base is 500,000. By converting from accounting base to the tax base, am I paying more taxes or less taxes? Tell me. By converting from accounting base to tax basis, in this case, am I paying more taxes or less taxes? This gives you a credit balance, meaning is that liability or asset? Meaning what? Meaning you're paying less taxes, right? Is that true? Why am I paying less taxes? Because the carrying value is lower for tax purposes than accounting purposes, meaning for tax purposes, you deduct more expenses or less expenses. The carrying value is less. That means you deduct more expenses or less expenses. Less, more expenses or less expenses, your carrying value is less. Okay, this is like a grade 3 math question I'm asking you. And many of you are in third year university now. Okay, so I'm asking again, when you have, these are the asset value, right? The asset value for the tax purpose is lower than the book value, right? So are you deducting more expenses on the tax basis or deducting less expenses for tax purposes? The carrying value is less. So that means which one, which carrying value is less, tax or accounting? So that means the tax bases are deducting more expenses or less expenses? How do you come up with the carrying value?
Cost minus depreciation and house minus CCA.
Okay, so this is less, right? So this is less. So let's say if this is 100, this is 50. So which one did you deduct more expenses? Because this is less, right? Which one did you deduct more expenses? Which depreciation is higher? Tax base or accounting base? You have to deduct more so that your carrying value is less, right? No? No? Yes, no? Again, go back to your grade 3 math and figure that out. Okay. Now, so this is what means, when you're deducting more expenses, is the profit going to be higher or lower? Lower, right? That means they're paying less tax now, right? Isn't it? Is that right? You're paying less tax as a result, you have a liability, right? At the end of the day. The reason you have a liability is because by converting it, you're paying less taxes, you're deferring the tax into the future. That's why this is a liability. Please understand those concepts, even though the schedule tells you what it should be, but you should still understand it just to make sure they're correct. Do you follow? Are you okay? Yes? No? Okay, I hope you can survive with this. Okay, let's go on, and then the next question we give you is the capitalized development cost here is 200,000, right? And why is that a liability again? Because this is expensing more than this, right? Because everything is expensed here, and this one you have an asset. So that means this is again paying less taxes for you. That's why this is still a liability. Do you follow the logic? Do you understand what we're doing here? Now, it's not necessary that you have to go through every single line like this to think about it, but I just want to understand the concept here. Is everybody okay? All right, but take a look at this and go back to your first paragraph underneath the table. What did it tell you? Is that matching to the first paragraph underneath the table, the first table? That ties back. This is how you calculated the deferred income tax, right? Are you okay? Do you have any question? Everybody's okay? Because of the timing difference, you're creating a total DIT that should be in your book of 105,000 liability. That's what it should be in the book, right, at this point in time. All right, let's go back to the following year. I just want to at least cover 1 year with you. So what's my carrying value of my equipment? I need to take the tax base and subtract my CCA, right? In the first year, the CCA is 80,000. So that means that my carrying value should now be 320,000, right? And for depreciation, my depreciation is 65,000. So I need to take my carrying value of the book, which is 500, minus the 65. So I should be getting 435,000. So that means the difference is still a credit of 115. I'm still at 35% tax rate, and this is what my deferred income tax should be year to date. Year to date, right? You need to figure out what the journal entry for this period is. Then you subtract it when you recorded last period. Your liability has gone up, so that means you only record the difference, right? Into this period's journal entry. Do you follow? Do you understand what we're doing here? Does everybody follow what we're doing here? This calculation is giving the year-to-date DIT. To figure out what journal entry you make for this period, you have to compare the last period as well, right? So last period, you have already 35,000 in the DIT account. This period, you have to increase it to 4250. That means you have to make a journal entry of a liability of 5250 to make it equal to this, right? That's the journal entry you have to make in this period. Are you okay? What happened to the second one? What did they say? Now, a tax basis will always be 0. For accounting purposes, they have starting with 200,000, they incurred 50,000, and they amortized 40,000. So that means they have 210, right? Now remember, these are all assets, so that's why they're all debit, right? That's what we recorded here, and then again, you would have a liability of 73,500. Last period, you have 70,000, so this is your liability. This is the increase in liability you account for. So your total adjusting entry should be 8750. Now you are increasing liability, so what do I debit and what do I credit? The offset is always income tax expense, but in this case, you would have to credit deferred income tax, right, in this case. So basically speaking, your journal entry should be debiting income tax expense for 8750 and crediting DIT for 8750. You know that in this case is an increase in liability, so you know you have to credit it, right? So that means that the expense on the debit side. Now many times it could be the reverse. If you create an asset, then the expense will be credited, right? The journal entry are those two items always, right? It's always the income tax expense and deferred income tax. It could be either debit or credit on the liability side or the asset side. Then the expense would just be the offset, right, to these accounts. Do you understand the first years of entry? Are you okay? I'm now gonna ask you to see if you can complete the rest of this schedule. Tomorrow, I would like to take it up with you in the makeup class, so that the added classes, so we can actually complete as many chapter 18 as we can, and then we're gonna be able to wrap up the rest. I think we only have 4 more classes, I think, after, we only have 3 more classes, right, after this week's class. and there will be a final exam. So there's still a lot of topics to cover. Okay, we still have 4 more topics to cover, so there's a lot to do in the next little while. Is that okay? Okay, okay, I'll see you guys next week then. I'll see you guys tomorrow, I guess. Okay, thank you.